Welcome back to Boss Economic World, where we don't just peel the onion of the global economy, we slice it, dice it, and occasionally cry over it, so you don't have to. I'm your host, digging into the financial trenches to find the truth behind the numbers. Today is December 11th, 2025. Now, when you think of the economic engine of South America, specifically Chile, what comes to mind? Copper? Sure. Lithium for your EV batteries? Absolutely. But what if I told you that the real heavyweight champion of the Chilean export economy isn't a metal dug from the desert, but a small, round, red sphere that expires in 2 weeks? That's right. We are talking about cherries. Forget red gold as a nickname for copper. In 2024, Chilean cherries actually generated more revenue for the country than lithium. Let that sink in. A perishable fruit beat the battery metal that runs the modern world. But as we stand here in late 2025, looking at the data, this sweet success story is facing a sour reality check. The cherry miracle is showing cracks, and it's a classic economic case study of oversupply, commoditization, and the brutal efficiency of the invisible hand when it decides to slap you in the face. Today, we are going to analyze the truth behind the great cherry bubble, why Chilean farmers are currently sweating more than a hedge fund manager during a margin call, and what this tells us about the future of global agricultural trade. First, let's restore the full picture. How did we get here? For the last decade, Chile has pulled off an agricultural magic trick. They realized that their summer is China's winter. Just as the orchards in the US, Turkey, and Spain go dormant and freeze over, Chile's Central Valley heats up. The result? A multi-billion-dollar export sensation. Currently, Chile controls roughly 50% of global cherry shipments. But here is the statistic that should make any risk manager nervous: 9 out of 10 Chilean cherries go to China. This isn't a diverse portfolio, this is putting all your chips on red 27 at the roulette table. For years, it worked. The fruit lands just in time for the Lunar New Year, where red is the color of luck, prosperity, and apparently high-margin agriculture. But here is the rule of Boss Economic World: when profit margins are juicy, everyone rushes into the orchard. Last season, and continuing into the start of this 2025 to 2026 season, the market taught Chilean growers a harsh lesson in basic economics: supply shock. Growers, drunk on the high prices of previous years, expanded their acreage aggressively. They planted trees like they were printing money. The result was a record harvest that hit the Chinese market like a tsunami. But here is the twist: it wasn't just too much fruit, it was bad fruit. In the rush to capture the early season premium, those first few weeks when buyers in Shanghai pay astronomical prices for the first arrivals, exporters started cutting corners. They sent fruit that was too soft, too small, or simply not ready. Let's look at the Nimba variety. This was pitched to farmers, including veterans like Jose Sainz, as the next big thing. It was supposed to be the iPhone 16 of cherries, early release, big hype. The reality? It was the Samsung Note 7. It bombed. Pablo Alvear, who manages a Chinese-owned packing plant in central Chile, put it brutally: huge fruit, but with soft texture and bland flavor. The Chinese touch it once and don't want it. The variety fetched half the price of traditional strains. Why? Because the Chinese consumer is not just a wallet with legs. They are sophisticated. When you try to sell a soft, bland cherry to a market that treats this fruit as a luxury status symbol, you destroy your brand equity. Andy's New Varieties Administration, the company behind Nimba, had to issue a public defense, essentially saying, the fruit is fine, you just grew it wrong. But the damage was done. The market isn't stupid. If you sacrifice flavor to get to market 3 days early, you lose the customer for the next 3 years. Let's look at the numbers for the current 2025 to 2026 season. Originally, the projections were terrifyingly high: 131 million boxes. That would have smashed last year's record of 125 million boxes. However, Mother Nature, acting as the ultimate market regulator, stepped in. Adverse late-season weather has dragged that projection down to about 110 million boxes. Paradoxically, this production drop saved the industry from a total price collapse. As we speak, the first Cherry Express ships, the maritime vessels that take 23 days to cross the Pacific, have arrived at the port of Nansha in southern China. Because the air freight disaster of the early season is over, prices are stabilizing. Farmers like Jose Sainz are reporting that prices for double jumbo fruit are holding steady. The market has cleared out the garbage and is now paying for quality. But the volatility shows just how fragile this trade relationship has become. To understand why this matters, you have to understand the physics of the trade. This isn't selling coal or copper. This is selling a ticking time bomb of fructose. To pass the test of a Chinese importer in 2025, a cherry must meet the gold standard. 1. Size, exceed 28 millimeters. 2. Solidity, more than 18% dry matter. 3. Aesthetics, deep mahogany hue, green stem. 4. Texture, crunchy. Mario Morera, a top agronomist, notes that moving up just one size grade adds roughly $1 per kilogram to a grower's return. In an industry with razor-thin margins, that dollar is the difference between bankruptcy and a new pickup truck. The buyers are getting high-tech, too. JD Fresh, the produce arm of the Chinese retail giant JD.com, is no longer taking farmers at their word. They are now tucking measurement calipers into boxes to assure buyers of size and consistency. Imagine buying a bag of chips and having a ruler inside to measure the potato slices. That is the level of scrutiny we are seeing. Why? Because the novelty premium is dead. This brings us to the core economic argument of today's episode, the commoditization trap. 10 years ago, giving a box of Chilean cherries in Shanghai was a flex. It was a luxury gift, like a bottle of good scotch. Today? It's a common snack. Pablo Alvear notes, it used to be that giving someone a box of Chilean cherries was a luxury. Now it's a more ordinary gift. When a luxury good becomes a commodity, the economics change. You can no longer charge a premium just for showing up. You have to compete on volume and efficiency, or you have to pivot to ultra-premium. We see Chilean growers trying to adapt. They are moving away from bulk 5 kilograms boxes and creating snack-sized packaging for younger, health-conscious Chinese consumers. They are trying to sell nutrition rather than status. But this shift comes with a massive headache: rising costs. While prices are stagnating due to oversupply and commoditization, the cost of doing business in Chile is skyrocketing. 1. Climate change. The Central Valley is getting warmer and drier. Farmers are being told to install shading systems, greenhouses, and advanced irrigation tech. This requires capex. As farmer Alejandro Prieto says, costs keep rising while returns fall. That's not sustainable. 2. Labor and politics. We have a runoff presidential election coming up this Sunday. One of the candidates, the conservative José Antonio Cast, has vowed to crack down on irregular immigration. Why does this matter for fruit? Because the cherry harvest relies heavily on seasonal workers from neighboring Bolivia. If you shut the border, you have no one to pick the fruit. No pickers equals rotting assets. 3. Logistics. The supply chain is a nightmare. One freight hiccup can turn a shipload of profits into a shipload of compost. We also need to look at the ownership structure. It's no longer just Chileans selling to Chinese. The supply chain is vertically integrating. Chinese nationals are relocating to Chilean towns like Curacao and Rancagua. Chinese investment groups are buying the farms and the packing plants. Conversely, big Chilean exporters like Garces Fruit are opening offices in Shanghai. The two economies are becoming fused. China is Chile's biggest trading partner, and Chile is China's fruit basket. This interdependence is efficient, but it's risky. If the Chinese economy sneezes, Chile gets pneumonia. So, what is the takeaway for us? The Chilean cherry industry is a microcosm of the global economy in 2025. It shows us that scale is not a strategy. For a decade, the strategy was grow more. Now, the strategy must be grow better. The market has reached saturation for mediocre products. The invisible hand is currently wearing a caliper and measuring every single fruit. We are seeing a bifurcation in the market. The winners, farmers who invest in technology, grow the Santina or Rainier varieties, and hit that double jumbo spec. They will continue to make money because the wealthy Chinese consumer will always pay for excellence. The losers, the volume chasers. The guys who planted Nimba hoping for a quick buck. They are about to get crushed by the weight of their own soft fruit. The economic lesson: when you build an entire industry around a single client and a single event, you are trading stability for velocity. It works great on the way up, but the moment the music stops or the fruit gets soft, the hangover is brutal. As Hernan Garces, the CEO of Garces Fruit, wisely put it, the future is quality-led, not volume-led. That is the truth behind the event. The red gold rush is over. Now, it's time for the red diamond era: smaller volume, higher value, and zero tolerance for flaws. I'm your host, signing off from Boss Economic World. Remember, in economics as in agriculture, don't pick the fruit before it's ripe, and never bet the farm on a single buyer. See you next time.